Okay, folks, it's last week. So my agenda today is to obviously help you get a sense of what the final exam is going to be like. We will definitely go over the final exam, sample final exam questions that I have posted yesterday, and then that's it. And then no more new topic, or no more new topics, obviously. And the rest of the few weeks afterwards is your prep time to study for the exam. All right. So let me um, remind you where the things are, the files that I told you about were. So under week 13, I said there's sample final exam questions. Here they are. I won't go through all of the questions solutions because I think questions 1 through 4 is something you can easily pull out from the slides. So I'll briefly talk about it, but definitely, go through the slides and identify where I'm pulling the questions from, and then try to fully understand what I'm asking. So I definitely won't ask you, one question, one type of qualitative response for those kind of questions, Q1 through Q4. I probably will combine them into, like true, false. I say something, you have to say true or false, and then explain why. Some kind of like that. So it's not going to be as easy as the sample exam questions. So just be prepared for something a little bit more condensed. Okay. And also a reminder, case study 2 is due not this week, but the last day before you start your exams. So you have also plenty of time to work on it, but the only topics really covered in the case study are swaps. So if you have that, you should be good to go. Okay. Somebody asked me about whether or not you have to use the same groups as the first case study, and the answer is no. You just have to make sure you're only in one group, so I can assign 1 grade per person, right? If you're in multiple groups, then I don't know. Okay, I take an average or something. Anyways, don't do that. Okay, so let's finish off from last time, which we were trying to understand Bitcoin. So we finished with that video that we watched, and I don't know how much you got out of it. Of course, as practitioners and users of the blockchain, you don't really need to know, the computer science behind all that stuff, right? All the algorithms. It's interesting if you want to study like, if you want to study algorithms, but from a finance practitioner point of view, it's kind of excessive. You just need to know how to use it. So if you were to take anything away from the video, I've summarized it with these bullet points. Okay. So number 1, what is Bitcoin? It's a ledger or a database of transaction history. All right. So you might see questions on the CFA that ask you exactly what Bitcoin is. They might say, is it a token? Is it some kind of asset backed, a digital asset that's backed by something physical? No, it's just a list of transaction histories up to some point in time. Right? The entire list of transaction is the blockchain, or is the Bitcoin. Okay. Yeah. Second, the reason why Bitcoin is secure is because there's incentive to there's incentives from the people who produce the blocks to solve a cryptographic puzzle. So imagine it like a lottery in which you have to exert effort, and the amount of effort they have to exert is proportional to what they get for the lottery. Okay, I mean, win in the lottery. If they win the lottery, they get some money that they can spend within the ledger, right? That's what you hopefully got out from the video, right? The video tells you that all these so-called miners compete to secure the blockchain, and they secure the blockchain by trying to solve this puzzle. You can think of it as a lottery. If they win the lottery, they get some money, and they can spend, and then that money is theirs to spend, right? That's how this blockchain works, or the cryptocurrency blockchain works. So what exactly is the Bitcoin trying to solve? So the problem with physical currency and also digital currency is the following, right? Somebody just takes like a Hong Kong dollar, like some money in your wallet, and they just use a printer and they scan it, right? So basically, I can create infinite money if I can faithfully copy currency using a printer, right? That's called a double spending problem, right? There's many things they try to overcome that, right? They serialize it. They have a unique serial number, right? They also have holographic prints, right? Making sure that the money is real. The same idea. Things become even harder to the currency becomes even harder to say it's genuine when it's digital, right? Because it's not physical money anymore. There's no hologram anymore. How do you make money unique? And the way it's made unique is through this entire system, right? Of computers solving for puzzles and so forth. Okay. So I'm not going to go into the details, but if you want to learn more about the algorithms and why it works in the first place, you can Google this Byzantine generals problem. So that's basically what the problem they're trying to solve. In other words, the double spending problem. And based on this, very, very technical system that they have in place to verify transactions, they can overcome this double spending problem. All right, so that's the takeaways from the video. All right, so once you have an idea of how the Bitcoin works, the question you ask yourself, well, what are the drawbacks? What are the problems with working with this so-called Nakamoto consensus, right? This is the rules that every miner abides to in order to secure the blockchain. Nakamoto consensus just says that the sequence of transactions that has the most computational work applied to it is the real chain, right? That's the way they agree among all the miners and also users of the blockchain that's the ledger that's genuine, right? All other ledgers are not genuine. It's the longest, it's the chain, most likely the longest, but more precisely, it's the one with most computational work applied to it that gives you the genuine Bitcoin. Okay. Just based on that description, it's already easy to imagine how things could get really complicated, right? What happens when there's ties, right? What happens when you have two competing blockchains that evolve in parallel and the way they extend each other can go on forever, right? Or for a long time. And so what you could have is you have these stale blocks that were successively mined, or there's a puzzle solved for it, but it turns out not to be the true genuine chain in the long run, right? So you have these dead branches, right? Essentially in the blockchain that nobody pays attention to anymore. So remember, it's the blockchain that has the most computational work, but there may be points in time in which different branches of the blockchain have the same amount of computational work applied to it. And so you have these dead branches or stale blocks. All right. So just by design, the fact that you can have ties makes this entire system a bit slow and cumbersome, as I will show you. Okay, it takes about 10 minutes to verify a block on average, and usually for a transaction to be confirmed as genuine, you have to wait for three blocks added on top of your transaction. So 30 minutes per, confirmation, which is ridiculous, right? I go to a 7-Eleven, I buy something, I just swipe my credit card, done within a few seconds. But for Bitcoin, if you want to use this protocol, you have to wait potentially up to 30 minutes in order for the store clerk to confirm that your money is genuine. Okay, so that's number one, right? Number one problem. Number two problem is there's a possibility, although it's unlikely, that you have a concentration of computational power for a given that's owned by one entity, right? Imagine there's a rich, I don't know, billionaire that decides to buy the universe of Bitcoin miners, and basically what that means is that all the Bitcoin is being produced by one person, so he controls the blockchain. If that's true, then he can just make up fake transactions and just give himself free money, in which case the entire Bitcoin is worthless, right? If there's going to be fake currency being transacted on the blockchain, fake transactions, then the entire blockchain is compromised. You would never transact on it anymore, right? That's the whole point. The whole point is Bitcoin is secure because every transaction is vetted with computational work, and it's very, very difficult to undo those transactions, right? You have to redo the work otherwise. But if you own 51% of the computational power, then you can just make up transactions, right? Nobody can beat you, right? But the reason why it's difficult to sustain the 51% attack is because you have to keep this going, right? you have people competing against you, and there's incentive from a game theory perspective to cheat, right? To break, to not collude, right? Somebody, if you're working with somebody to consolidate mining power, you have incentive to betray your business partner, essentially, right? So even though it's hard to sustain a 51% attack, it's still possible, in which case the entire blockchain could be compromised. And if that's true, then you would never transact on it anymore, right? Okay, so that's the pros and cons of Bitcoin. Pros, it's very secure because computational work is very, very hard to redo and undo, or you can't undo, it's permanent. And yeah, so that's the main selling point. But it has downsides. Downside is it's very, very cumbersome and slow. And as I will show you, it takes about 10 minutes to verify a transaction. And most merchants will need 3 confirmations, in other words, up to 30 minutes to confirm a transaction to be genuine. Okay. And number 2, it's subject to what's called a 51% attack. If some entity have 51% of computational power, it's possible to make fake transactions. So basically, they bought the money printer, right? Essentially, if you want to make it into a analogy, someone got all the money and decided to buy a money printer. They just started printing money, right? In which case, money is going to be worthless, right? Okay, so that's Bitcoin in a nutshell. And so I have given you some instructions to test out receiving and sending Bitcoin. So if you're curious, you can, depending on if you have an iPhone or a Android phone, you can just follow these these steps. So let me, I skipped it. Oh, good. Okay. So the slides that's posted on Canvas has the instructions to download the app and create the wallet and so forth. But I'm just going to show you how it's done. Okay. So once you have the app, you will create a wallet. So just follow the steps. You create a wallet. That creating a wallet will give you an address. So just think about it. Think of it like an email address. It's basically the same thing. Okay. You get an email address, and with that email address, you can send to that email address money. Okay. How is it done? Well, let me show you what it's like. So I have to. So let me show you. Let's see. Bitcoin faucet 01, I guess. Nope. Okay. All right. So this website is a way to, it's called a faucet because, like a faucet that pours out water, you can get free testnet Bitcoin. So testnet means that it's just the blockchain solely exists so that people can build programs on top of the blockchain that uses the blockchain. So if you want to build an app to exchange cryptocurrencies, you would build the app using the testnet coins, which is worthless. It's worthless because as long as you get the miners to agree to reset, you can reset the blockchain. So if you have 100 testnet Bitcoin, they reset it, that means you get 0. You have nothing left. Okay, so that's why it's worthless. Okay, so I will send myself some Bitcoin. So let me show you. Here it says I can send myself up to 0.00008 units of Bitcoin. Cool. And I'm going to type in my testnet address. So once you create a wallet, you'll get a testnet Bitcoin address. And I'm going to find it here. Okay, let's see. My address is the following. You don't have to, I'm just showing you. There's nothing to write here, okay? TB1Q. Okay. Let's see if it works. Cool. So 0.0008 coins were sent to this address that I got from my wallet. Look, it's a QR code, right? I typed it in because it's a website. So I typed in that address, which can be a QR code. I've set myself this. So how do I track the transactions? There's something called a block explorer. So like I said, Bitcoin is just like email through the website, okay? Where all your communications are public information. So block explorer allows me to observe the transaction on the testnet blockchain. So this is the testnet blockchain. So these are just like in a video, you can go to the first block to see who transacted to what. So just like testnet, you can do the same. I'm just going to put in my address to see, to confirm that something was sent to this address. And indeed, one transaction was sent, right? It's unconfirmed, right? So one output 0.00008 TBTC testnet Bitcoin. All right. So unconfirmed just means that it has not been mined. The block has not been mined yet, right? That has your transaction in it. You have to wait on average 10 minutes for it to be confirmed. But usually, again, merchants will require 3 confirmations on top of your transactions before they will believe that your coins that's being sent is genuine. Okay, we'll leave this here, and we'll come back to it in maybe 10 minutes to see if it's done. But just to let you know, right? It is still unconfirmed, right? Still unconfirmed. Oh, it's confirmed. Confirmed. Cool. So less than 10 minutes. Someone mined the block, right? But it's only one block so far. So let's see. All right. Anyways, that's transacting Bitcoin. Okay. All right. So some more details I want to mention here. Yes. So follow these instructions right on the slides if you're curious. I know Bitcoin is banned in China, but Hong Kong is still kind of Wild West here, so you should experiment. So just to give you some little nitty-gritty details. So as I said, the address that you get from creating a wallet, which is like creating an email account, it's not exactly the email address. Actually, there's 3 layers to create the so-called public address. You start with a public key, you run it through an algorithm that spits out another key, and you keep doing this 3 times, and that's how you get the final so-called address, okay, public address to receive the coin. And as you saw from the video, having the public address shows that something was sent or received, right? But in order to spend the money, you need the private key, right? As you saw from this video, okay? So having both the private and public key allows you to spend the money, but having just the public address just shows that something was sent, right? Okay. Yes, so we did this. Okay. And you can do this yourself, send it to each other, just experiment, and hopefully you get some exposure to fintech. Okay. All right, so the question you probably are asking if you're a finance person is, how should we value Bitcoin, right? The nutshell here is that Bitcoin is essentially a commodity. It's the way to price Bitcoin is the same way to price, should be the same way to price oranges, coffee beans, wheat, gold, etc. It doesn't emit cash flows, right? Unlike stock, it doesn't emit dividend payments. It doesn't emit interest payments. So we can't use DCF to price Bitcoin because it makes no sense whatsoever. The only way to really think about Bitcoin is, do you expect someone to buy this coin sometime in the future, right? It's like a game of hot potato, which is essentially what gold gold is. Gold is also a speculative asset. There's no reason for why gold should have X price or Y price. It just depends whether or not you believe somebody will buy it from you or sell it sometime in the future. That's why it's a commodities market. It's unpredictable. But anyways, we can try to value Bitcoin using the models in this class. So let's go ahead and take a look at the reasons why. First of all, reasons why you think Bitcoin should have value. So the first thing to think about is relative to traditional currencies, what sort of additional benefit does Bitcoin afford to you if you decide to use it? Okay. So if you haven't been paying attention to the news yet, it is what's called censorship resistant and borderless. The reason why I mentioned the news is because a lot of people speculate the reason why North Korea has been able to develop their nuclear weapons, why Hamas has been able to generate enough money to buy weapons. The reason why they can do all this is because cryptocurrency is censorship resistant and borderless. Okay, why? Because they circumvent the entire global banking industry. Right? As long as there's an exchange that's willing to exchange fiat for crypto, you can essentially move money around without being detected, right? So that's what it means to be censorship resistant. The banking industry can't stop you from moving money, right? There's no way to do it. It's borderless for obvious reasons, right? Because it's global. It's it's a commodity slash, you want to call it currency. It's a currency that can be transacted literally in any country across different borders, right? If you want to circumvent China's capital controls, if you're able to get cryptocurrencies, that's one way to move money, right? All right, so that's probably the most beneficial aspects of Bitcoin. Nobody can stop you, and it can be moved around anywhere. All right, so money laundering obviously is a tool that people use crypto to do, right? That's the only way Iran, those other terrorist countries are able to finance their plans. Okay, all right. Other things to think about, compared to central banks, Bitcoin has a benefit in the sense that its monetary policy is very transparent. Why? Because it's literally in the code. So if you look at how the miners mine the Bitcoin, you look at the code, you will see that there is a maximum units of Bitcoin of 21 million, right? That you saw in the video. And you also saw that the mining must on average take about 10 minutes to accomplish, right? The lottery has to be done within 10 minutes on average. So that's all written in the code. So you know precisely how money supply grows, how fast, and there's a cap, 21 million. And that's universally known, right? That's immutable, unchangeable, unless the universe of miners agree to change the code somehow, which they have. So those are called hard forks. Okay, so if you look at Bitcoin, you should also notice that there are different versions of Bitcoin out there as well, right? There's what's called Bitcoin Cash, there's Litecoin, there's I think Bitcoin Gold, Bitcoin Silver, whatever. All these other blockchains are just derivatives. In other words, they're just borrowing the code base of the original Bitcoin and just tweaking it in the sense that there's more money supplied, there's faster transactions, etc. These things can be tweaked. But the takeaway here is that the monetary policy is transparent. You know how fast the money supply grows. There's a limit of the money supply. For most blockchains. Some blockchains have infinite supply, like Dogecoin. Okay, it prints money indefinitely. But anyways, it's transparent because it's written in the code, right? There's no monetary policy uncertainty whatsoever. And another feature is it's immutable. Immutable in the sense that it's hard to reverse it's basically impossible to reverse transactions, because if you want to reverse a transaction that takes place, 100 blocks in the past, that's going to take a humongous amount of computational work, which is impossible to do, right? You have to undo not only the growing chain, but also everything in the past too, if you want to change something in the past. So this is, people say this is a feature, but others say that this is it's bad because there's fraud, right? Obviously, if you've dealt with credit card companies to buy something, somebody may steal your identity, spend your credit card money, and it's impossible to reverse the transaction if you don't have, a third party managing the transactions, right? The credit card companies on your behalf. If you do it through the Bitcoin, then nobody's there to help you, right? Okay, so to summarize, cryptocurrencies, Bitcoin has value, but it's not the kind of value you kind of expect, right? It's not that having Bitcoin, you can buy certain things, right? It's not like having US dollars, you can go ahead and buy US goods and services, you can buy iPads, you can buy iPhones, you can buy rocket ships, you can buy legal services, whatever, right? That's what it means to have US dollars. You have Chinese dollars, same idea. You have Chinese dollars, you can buy manufactured goods, you can buy Huawei phones, you can buy all sorts of things, right? But having Bitcoin does not give you access to anything in specific, right? It doesn't. Some may say you have access to Guatemalan goods and services. If you read the news, Guatemala is a country that has adopted Bitcoin as their currency. But my understanding is that nobody's using it. Okay, so that kind of argument I don't buy, right? I don't buy that Bitcoin gives you access to specific country. No. Yes. What Bitcoin does well is the first 2 points, right? This is how terrorists finance their terrorist activities. This is how bad actors are able to circumvent the law. This is how people do illegal activities. Yes, Bitcoin does this very well, okay, for obvious reasons, right? As long as you can find somewhere to find an exchange that's willing to convert your money, like Binance, right? You can definitely withdraw your currencies in fiat currency and buy whatever you want later on. But the point is, once you do the transaction on the blockchain, there's to some degree of anonymity, right? Okay, borderless, obvious, right? It's a currency that's not regulated by any country, so it can transact across borders. All right, and the last 2 bullet points is immutability, meaning transactions are virtually permanent, basically permanent. You can't undo. And transparent monetary policy. Some people believe that central banks are bad, but hopefully you came away from this class that central banks are good. Okay, that you want, as a country, you want to have your own currency. You want to be able to control interest rates. You want to be able to conduct fiscal and monetary policy to some extent, so that you can control the growth path of your country, right? You want to, as policymakers at the very least. If you give yourself up to, another country's currency or the Bitcoin, then you don't have that ability to do that. There's no interest rates, right? There's nothing for you to control the speed or influence the growth path of your country. Okay. All right. So hopefully you got a sense of what Bitcoin is, pros and cons, what it's primarily used for, some examples of real life, what has been going on. People have realized is that all the bad stuff has been going on recently, potentially has been caused by the advent of Bitcoin, okay, and other cryptocurrencies. All right, so why shouldn't it have value? So as I said, just like any other commodity, commodities are speculative. So you're just betting that somebody else sometime in the future is going to buy or sell it, and that could be nobody, and therefore whatever you're trading or using it to trade it's not worth anything. Okay. It could also theoretically lose all its value simply to people adopting competing currencies. So the analogy I'd like you to think about is the following. So I don't know if you know about Facebook. Facebook is I don't know what the corresponding is. It Weibo? Is Weibo the Facebook US? Okay, anyway, I don't know. But Facebook, you probably know, it's a social media platform where people communicate with each other, share news, blah, blah, blah. But they were not the first, right? If you know about the industry of social media, there were lots and lots of platforms before that preceded it. One platform, namely, was called MySpace. MySpace was a blogging space where people could do the same thing: share photos, share music, communicate with each other. But what happened is that everybody moved from MySpace to Facebook, right? And therefore, MySpace is basically worthless. Nobody's on it. If nobody is on it, then it's worth nothing, because you're buying. People are selling ads on MySpace. Nobody's looking at the ads, right? Nobody wants to mine the block, right? Because nobody's using it. Then the same idea for Bitcoin. So for Bitcoin, if there is a superior, better technology that's probably more censorship resistant or has better algorithms that secures the blockchain, then everybody will move to that blockchain and nobody's using Bitcoin anymore. If nobody's using Bitcoin, then basically there's no blocks to mine. If there's no blocks to mine, there's no incentive to mine, and it's worthless, right? Bitcoin is worthless. So it's possible Bitcoin could just become another MySpace in cryptocurrencies. Okay. And as I said, why don't we just use, so another thought experiment is, why don't we just use testnet Bitcoin? Well, just like the blockchain, somebody with 51% could just compromise it. The same way testnet Bitcoin could be arbitrarily reset, right? That risk is always there. And if that's always there, then why should money have any sort of value? So remember, money, real money, fiat currency, is backed by tangible goods and services. It's a loan. It's a loan. We're essentially borrowing from each other, right? And we're making promises. And so we're backed by each other's promises. Bitcoin, on the other hand, is backed by literally nothing. It's speculative. And there's no reason for why you should think it has any sort of fundamental value, other than the fact that somebody in the future may buy it from you at a higher price, right? Just like any sort of commodity. If you think it does have value, then it's basically your expectations about people, doing this, right? If somebody's gonna buy that currency from you, is because they might be able to circumvent laws to do whatever illegal activities they might want to do in the future. Good. All right. So that's the big picture idea of why cryptocurrencies has value. Censorship resistant, immutability, blah, blah, blah. Why should it? It's like a commodity, it's speculative. And if its value comes from people using the currency and trading and transacting on the blockchain. Once transaction stops, then it has no value, right? Okay, so let's try to value Bitcoin. Let's try to value Bitcoin using using the models you learned in this class, all right? So the first model I want you to think about is the relative purchasing power parity. If you recall, relative PPP is a long-run model to look at long-run returns of a currency with respect to differences in inflation rates, right? So if you forgot how to derive it, right, it's derived from the real exchange rate. We use the rule of changes, and we solve it for Q equals constant, and we get the long-term condition, which states that the return on the foreign currency must be equal to inflation differentials between two countries, right? In the long run, right? We're looking at long-run returns. Okay, so the foreign currency in this case is Bitcoin, and we're pricing it using US dollars. So we're looking at the inflation rate between USD and BTC. We know BTC's inflation rate, right? Because it's written in the code. 10 minutes every block is extended 10 minutes every transaction. So you can calculate how fast the money supply grows every year and so forth, right? Inflation rate for US dollars, that's also observable. We know what that looks like. Okay, so to give you a sense of, so what we're going to do is we're going to decompose inflation into, as you should know, two parts: money demand and money supply, right? Money, right? Because using the rule of changes on the money market equilibrium, we get a breakdown of the change in money's demand and the change in money supply. And we're going to try to input some variables into this equation here. Okay, so let's look at Bitcoin returns. So I apologize. Oh yeah, listen. So the way it's written, BTC is the foreign currency and USD is the domestic currency. And we're going to look at its monthly returns in terms of US dollars. And we're going to compare it to two different types of assets. We're going to look at the S&P 500 index, and we're going to look at the monthly returns on gold. So I hope you know what S&P 500 is. Okay, it's an index that tracks the top 500 by market capitalization of U.S. firms, and it's value weighted. So if it has more value, more weight is put on the returns of that stock. Okay, so that's S&P 500 monthly index. We look at its average returns. Okay, and this is the distribution over I forget, maybe 10 years. Okay, so it has a distribution. You should note that it looks like it's skewed left, right? Because the median looks like to be around above zero. So it's between 0 and 5%. So maybe 2% per year. Sorry, this is 2% per month, right? I think this is 0.05%. So it's 0.025%. Okay, so multiply by 12, that gives you an annual return. So mostly positive, and it looks like the highest values is around 10%, right? 10% negative, positive, and negative maybe, I don't know, 7%. Sorry, 0.07% and 0.1%, right? It's bounded, right? So that's not unusual, right? Hopefully it's within your beliefs that within a month a stock can at the most decline or drop by 0.07% or increase by 10.1%, and on average 0.025%. All right. Gold. So on average positive is of course not surprising, right? Because the top 500 US firms, you should expect to actually generate some value over time, right? So having an average or median that's positive should not be surprising to you, right? For gold is a bit different. The median is very obvious. It's 0. So that gives you indication that to some extent, gold is quite speculative, right? And you can see that the bounds, the maximum and minimum losses, maximum minimum returns or losses is wider, right? So that just means there's more disagreements or volatility in the asset. So not too surprising. Gold is compared with S&P 500 because gold is what's called a safety asset. And meaning that once there's a macro shock that affects all stocks, a lot of people may move into safer assets, and one of those safe assets is gold. Okay, safe in the sense that it's not stocks. Okay, so gold / bonds. Okay, now let's look at Bitcoin. Bitcoin, median of 0, right? 0% returns. But look at its bounds here, right? It's possible that within a month, Bitcoin could decrease by 100%. Right? It's possible. It has happened before. Here, it's possible that Bitcoin could increase by 200% within the last, I think, 10 years. I think this is 10 years data. Okay. So just based on this observation, comparing Bitcoin with gold returns and S&P 500 returns, it's very speculative, right? In fact, it's speculative in the sense that the median is 0, and it's even more speculative than gold because it's possible that Bitcoin can decrease or increase by over 100% within a month. It's crazy. Okay. Okay, so let's just take the median Bitcoin return of 21%, okay, which is already crazy, right? Within a month, you expect the average stock to change by 20%? No, it's crazy. But let's just say within the last 10 years, the monthly return of Bitcoin in terms of USD is 21%. And suppose monthly inflation. So I know these inflation numbers are outdated, but we can take the inflation rate prior to 2020, which is about 0, very low. Okay. We can assume it's 2%. And if you want to convert it to monthly, divide by 12, which gives us 0.16%. It's 2% because US has an inflation target of 2%. Okay, so we can just assume that in the long run, US will achieve its target on average. And just monthly inflation rate will just give us 0.16%. Okay, breaking down, decomposing using the rule of changes for percent change in price gives us percent change in money demand, sorry, money supply, and percent change in money demand. Concur? This just comes from the money market equilibrium, right? Just apply the rule of changes to the money market equilibrium equation. So that's MS equals P times L, right? And so that means that P is equal to MS over L. And then applying rule of changes gives us percent change. I'm gonna use percent D for change equals, I mean, it gives us this, right? Gives us this. I don't need to do that. So apply rule of changes, you get this, right? Yeah. Okay. So for the long-term equation, the long-term condition, we can substitute the inflation of BTC, breaking it down into money, change in money supply and change in money demand. That's these two components, plus USD inflation, which we substitute with 0.16%. We know the return, the monthly return of Bitcoin over the last 10 years. 10 years, I think, is sufficient for to say the long term, right? It's 21%, which is crazy. And inflation of Bitcoin is basically zero. It's basically zero, right? Because it's in the long term, there's only 21 million units of Bitcoin, right? So in the long term, that 21 million is fixed. So this money supply won't change after that 21 million. So let's just say it's 0%. And therefore, with these numbers, we can solve for the growth of money demand for Bitcoin, right? In the last 10 years. So just solving for this, you can already tell that after moving all the variables from the right side to the left side, this model tells us, relative PVP tells us that money demand, liquidity demand for Bitcoin is increasing at a rate of about 20% per month in the long term. Does that make sense? So if this is true, then we should definitely see mass adoption of Bitcoin, right? Which we don't, right? As far as I can tell, no merchant that at least I buy things from, accepts cryptocurrencies. You can't buy houses with cryptocurrencies on a universal level. Maybe under the table, but definitely not in legally binding contracts. And so I'm very skeptical. So the problem definitely comes from the fact that there's some kind of distortion coming from the returns, right? This doesn't make much sense. So there's probably too much speculation on the returns of Bitcoin. Okay, so that's one way to kind of think about Bitcoin. All right. If Bitcoin has value and is taken seriously, then you're assuming that based on this model, based on relative PVP, money demand for Bitcoin is growing at 20% per month. I don't believe that, and nor should you. Okay. Second model, we can look at the quantity theory of money to value Bitcoin. So in other words, we're going to solve for P and try to input M times V and quantity. Okay. So M is average supply of BTC Bitcoin. BTC stands for Bitcoin over a period. V is the average frequency of unit of Bitcoin spent over a period. So we can multiply velocity times supply. We can get that number somewhere, okay? And we want to solve for P, which is average over a period of time. And Q we can also get from the blockchain itself, okay? So we're going to assume a period is 1 day, and we're going to average over the last year. All right, so let me tell you where to get the data from. So just click on these buttons if you want to know. It's in the actual slides. If you click on it, it tells you where to get the numbers from, okay? So as of the last time I took numbers in 2020, I got this number. So the money supply times velocity is 857,000 units of Bitcoin. The amount of quantity being circulated is 461. This is per day. Okay, this is per day. 461 million. Okay, and we can solve for P. That's just simple algebra. Okay. We get the price of Bitcoin of $538 per Bitcoin. All right. So at the time, the quote of Bitcoin was 66,700, but now I think it's like 30,000, right? I mean, we can double check. Price. I just write BTC USD. Yeah. Okay. So I'm not sure exactly what happened in the last 3 years, but somehow that's markets think that's appropriate number. I don't know. Okay. But if you want to apply the quantity theory of money to value Bitcoin, well, there's a large discrepancy between using the QTM versus what's being quoted. So obviously, I think the market quote doesn't make any sense. Okay. So speculation, in other words, highly speculative. Okay, highly speculative. So something is irregular about the observed exchange rate, right? That's my takeaway. Okay, so given the models you have at hand for this course, right, we've successfully analyzed as best we could the value of Bitcoin. Our conclusions is too much speculation. And so the natural question you should be asking yourself is Bitcoin a bubble? Okay, so let's characterize what a bubble is. It's a bubble if it has the following characteristics, as we saw in the past with regards to mortgage-backed securities and tulips in the Netherlands. Things get wildly speculative when there's a, number one, limited supply. So Bitcoin, 21 million Bitcoin, people think it's scarce, and as a result, scarcity drives speculation about its, future people wanting to buy it, and therefore it should be priced higher, right? So with limited supply, that could drive its price upwards. High volatility just means constant people changing hands of this asset for no reason, right? They're not using the asset to get access to certain goods and services. They're just changing hands for the sake of changing hands, right? That's going to create lots of volatility. And high amount of trading volume. So this high trading volume doesn't necessarily mean it's a bubble, but for new assets like Bitcoin, this can be problematic because it's possible that exchanges create fake trades to attract attention. So yeah, so I wouldn't be surprised if Binance had this problem in which they had fake trades to attract people to buy and sell Bitcoin on their platform. Okay. All right, so obviously, based on these characteristics, Bitcoin fits the classification. And what's most important to think about when thinking about bubble, it's a bubble, especially if people are attracted to the assets or commodity, if there's lots of attention paid to it, right? Attention itself can drive the asset. So what that means is that there's a momentum pattern in the asset price. That is, past price predicts future price. Yeah. And as a result, that's going to create high demand for information, and which means that the price will be very, very, very sensitive to new information being reported, right? Being presented. And as a result, high volatility. So my task now is to show you evidence of this, okay? I will show you that most of Bitcoin's price movement is driven by just people's attention. Okay, a very simple analysis. We can do this together. All right, momentum. How do you do momentum? How do you estimate momentum? What we do is we regress. So hopefully you have background in statistics. You know what regression is. Regression is just trying to understand a relationship between two variables. In this case, we're trying to understand the relationship between past returns with future returns. Past returns is our lowercase rt, that's today's price. Returns. RT plus 1 is the returns in the future, the next period. So if there's momentum, then we should expect the co-estimated relationship, which is B, the coefficient. The estimated coefficient should be positive and very, very statistically different from 0, right? That's how you test if past returns predicts future returns. There is no reason for that to be true if, there's no reason for that to be true, okay? If there is momentum, you can, as a investor, you can implement a momentum strategy and just make, on average, positive returns. If you were to do this on gold or S&P 500 for the last 10 years, you would not be able to make any money, right? So this tells us that on average, the relationship between a 1%, 100% increase in S&P 500 return in the past gives us a negative 15% decrease in the future, but it's not statistically significant. So basically zero effect. So if you were trying to do a momentum strategy with S&P 500 or gold, you'll get no returns, maybe slightly negative, which is what the coefficient tells us, right? It's negative. If you look at Bitcoin, the coefficient is 0.028, positive, right? And it's very statistically significant. So momentum does work within the last 10 years. If you were to try to do this momentum strategy for Bitcoin, okay? I'm not telling you would make money for sure. I'm telling you on average you could, but most likely you would lose a lot too, okay? All right, so takeaway. Momentum trading is betting on winners and buying past winners and hoping that they still become winners in the future, right? That you bet on winners and you hope that the winners keep winning. You can try to do this with so that kind of strategy shouldn't be profitable, okay, right? That shouldn't be profitable from a efficient market. For S&P 500, it doesn't work. Gives you 0% return. For gold, 0%, maybe even negative, okay? For Bitcoin, it seems like it's possible. Again, perhaps there's an ability to predict information being released, or your information creator to stimulate attention, and that could drive asset prices in a direction. Okay. All right, so that's a very simple exercise to understand Bitcoin returns momentum. Let's go on to the other features. Now, this second exercise to associate Bitcoin return with attentions, we can now look at Google search results, Google Trends. So I don't know if Baidu search results have this feature, but you can download an index for how many people within a certain geographic area are Googling or searching some terms. So Google Trends in this bottom left-hand side is a measure of how often people are Google searching Bitcoin on the Google search engine, okay? And you can see from 2013, not much attention, but 2017 and beyond, crazy amount of attention, okay? Bitcoin price is on the top, okay? So around 0, but then slowly spiked to, I think, that's to 20,000, right? Almost 17,000, right? I recall that by end of 2017, it was around 17,000. Yeah. So without doing any sort of scatter plots, you can already tell that based on these two graphs, they're basically moving together, right? The attention is actually it seems like it's driving the Bitcoin price. If you were to do a scatter plot, you can. So this is what the scatter plot is. And if you want to draw a best fit line, you can also do that. This regression line actually has an R-squared value of 88%. So that means that this model, very simplistic model, is a very good fit. Again, giving more support to the fact that Bitcoin is a speculative asset and the asset price is primarily driven by people's interest. Okay, not linked to any sort of fundamental value. All right. Next, we can look at volatility. All right, so rather than give you a vague standard deviation term, we can actually just count the number of times in which the returns falls below certain thresholds. So here we have these thresholds of 0.05%, 0.1%, 15%, 20%, 25%, 30% declines, okay? S&P 500 within the last, I believe, close to 10 years, only once in which the stock dropped by 0.05%. Gold, 3 times, okay? Bitcoin, yeah, it's all over the map, right? There's so much volatility. There's not necessary to even compute standard deviation, right? This tells you there's just way too much volatility for the asset. Okay. So again, you should have your own opinion, okay? This is just my observation of the asset for the last, since I joined CityU in 2017. I'm observing this asset, and my takeaway is that there's no evidence that this asset is anywhere near the value of gold. Okay, it's not a digital gold. I don't think it's supported empirically, as there's no correlation between BTC and gold at all. Okay, it doesn't behave like gold at all. And really, the value comes. It's just whether or not you're willing to speculate that somebody else will buy it from you in the future for more money than before. So I'm not saying that cryptocurrencies are worth any less than fiat currency, right? Fiat currency and cryptocurrencies are both not backed by anything, right? That's the definition of fiat currency. It's not backed by anything, but it's backed based on our promises to trade with one another. If you've taken something away from this class, right? People who are cryptocurrency enthusiasts, they always make that claim that fiat is not backed by anything. I disagree. It's backed by our trust with one another. Okay, that's not Bitcoin. Inherent philosophy of Bitcoin is trust nobody. Trust the computers. Don't trust anybody. So it's different. It's a different kind of value system. Okay. Okay. So that's my take on cryptocurrencies. If you understand Bitcoin, I think you basically understand most of cryptocurrencies out there. And I think you already would know enough, maybe if not more than enough, for the CFA exam if you do take it. Okay. For those of you who are still interested in cryptocurrencies, I think what's particularly interesting in that space is actually the anonymity part of the currency. Okay. As you all know, there's a reason why cash is preferred in a lot of transactions, because you want to stay off the grid. Americans particularly a lot of Americans sometimes just don't like using credit cards. They don't like the cashless society because they don't want to be on the grid. They want to make transactions privately. And so there is a value for having cash on hand. You can also think about it from inclusivity perspective as well. If you have cash, you can include those who can afford phones, right? So there is a benefit for having cash. Bitcoin at this current stage is not completely anonymous, but if they're getting close to anonymous, then they get closer to having physical cash, right? You get that feature of being anonymous. There's certain blockchains that try to highlight this feature, such as LTC, which has a anonymity feature, but particularly Monero has a fungibility, claims to have almost perfect fungibility. Fungibility just means that one unit of Monero is the same as another unit of Monero, right? Just like my Hong Kong dollar is worth the same as another person's Hong Kong dollar, right? It doesn't matter which one I get. That's what fungibility means. But Bitcoin in its current stages is not fungible, right? One unit of Bitcoin is different from another unit of Bitcoin because one unit has a unique history and the other has its own unique history. So they're not fungible, okay? People try to make it fungible by using these mixers where they try to launder the Bitcoin, but you get my point here, right? You need fungibility to get anywhere near the characteristic of real cash, right? Cash is fungible. All right. Comments, questions on cryptocurrencies. So to summarize, Bitcoin and other cryptocurrencies, the entire history of transactions is the currency. Okay? That's takeaway number one. Takeaway number two, these transactions are secured because of what's called proof of work or Nakamoto consensus, which means that miners and people who use the currency believe that the true transactions come from the blockchain that have the most computational work applied to it. Okay. There is downside for this system. Downside number one, subject to 51% attack. That's always the risk. Okay, but it's people claim that this is very difficult to break. But as we approach the age in which we have, quantum computers, who knows, right? And also mining consumes a lot of energy. So I know accountants, you guys are doing ESG stuff, right? So mining is not ESG friendly, okay? Unless it's like thermal nuclear stuff, which I doubt. Most of them are just mining using coal plants, okay? All right. Second group of takeaways. Bitcoin is not a financial asset because we can't apply DCF. There's no cash flow. There's no interest payments, no dividend payments. So difficult to determine its intrinsic value. And so you see wild fluctuations. People claim it's a bubble, etc. Okay, and lastly, from my perspective, its value comes from its ability to circumvent capital controls, and also the so-called network effect, right? More people transacting on it gives you more faith that the blockchain has any sort of value. And some people may say that Bitcoin does give you access to certain goods and services. As I know, now there are certain pornography websites that only accept crypto. So if you have crypto, you can buy pornography. You can't spend cash. Reasons is obvious, right? People who consume pornography, I guess, are doing a lot of illegal activities and they don't want to deal with credit cards. Okay, cool. So that's my takeaway. So this is my list of references for further reading. Do you guys have any questions on cryptocurrencies, Bitcoin? So I guess the kind of questions you might have is, how do I test you on this, right? That's the questions I have. I won't ask you anything. I won't ask you to do anything like this, okay? So if you're concerned, I ask you to run regressions. No regression questions. I don't expect you to know statistics, and just some basic understanding of calculus is enough, okay? I won't ask you to run regressions. And let's see. What I could ask you about is, let's see. All right. What I could ask you, so again, I won't ask you to do value. I won't ask you to do this stuff, okay? Not for Bitcoin, but you might have to do this for actual currencies, okay? I won't ask you to do. Yeah, I will ask you is the characteristics of Bitcoin, what it's used for, why is it secure, how it's secured, what the Nakamoto consensus is, what's proof of work, and yeah, things like that. So if you watched that video once, it's already enough, okay? But if you want to dig deeper, by all means, you can check out the references in the slide. So to reiterate, the only kind of questions I could ask on the final on Bitcoin / cryptocurrencies is just about the features of the protocol. Okay. Yeah. So that's it. That's all the contents. So if no other questions on blockchain, I will just go over the final exam logistics. Okay. Oh, maybe I'll go over some questions, CFA questions first. So just for fun, okay. So this is a sample question that you may see on the CFA exam. So these are from a review book that I got in 2019 or 2020, as meaning that they want people to understand blockchain to some extent for the CFA exam. So let me read the question to you. A government decides it will privatize vehicle registrations if the province's auto insurance companies can record and maintain ownership titles using distributed ledger technology. This application of distributed ledger technology is best characterized as A, blockchain, B, tokenization, and C, smart contracts. So I didn't really talk about the other things, but just based on your understanding of blockchain, your takeaway from the paragraph is that there's no reason for there to be any cryptography involved, right? And you know that blockchain involves to some extent cryptography. So I think the best answer here, if I recall, should be B, tokenization. So tokenization just means record keeping of data on the blockchain. So recent things that have been hotly talked about is NFTs, right? How do you put information of art on the blockchain and sell it, right? That's one way to tokenize things, right? Non-tradable tokens, right? But you can do the same thing for auto ownership titles, license plates, diamond serial numbers, even money, currency can be tokenized in the same way. So blockchain is a generic term. So it's an answer I may consider, but definitely B is a superior answer compared to A. Smart contracts. Smart contracts is when you have executable code that's written on the blockchain. So so an example would be I write a contract to be executed from the blockchain that exchanges currencies between two people, right? But I have to write the code, right, between parties on the blockchain. Okay, so that's what smart contract entails. You need some sort of automation that's done, and that automation is executed once it's, I don't know, X amount of blocks after confirmation, after X amount of confirmation, maybe something like that. And once that, after amount of time, something happens. So it could be a transaction, it could be recording of something, anything, right? As long as it's code that's executed, it's called a smart contract. Okay, but it could also be like access to money. So you could have a smart contract in which it requires two private keys to use the funds, right? But you have to write the code in the blockchain. But the point is, you have to write the code on the blockchain. It's a smart contract, okay? Smart contract requires code to be written on the blockchain. So I'll give you two examples, right? One is an automation transaction or recording that takes place on the blockchain, but it has to be pre-written in code on the blockchain. And the other is, if you have the access to funds, you have to write code in which you need two private keys to unlock funds, right? These are all examples of code that's written on the blockchain, therefore called smart contracts. Okay. All right, so it's not C. Okay, so there's no code here, right? There's no automation, there's no access to funds or something like that. Okay, this is just recording information on the blockchain, and usually when you record something, you're tokenizing it. So examples would be NFTs, non-tradable, non-fungible tokens like digital art, and yeah, but it doesn't have to be art. It can be, like I said, serial numbers, license plate numbers, your grades. Maybe in the future, colleges want to record your GPA on the blockchain. It's possible, right? But that's what tokenization is, right? Just recording information on the blockchain. Okay, second question. Investors in an initial coin offering typically receive which of the following? A, voting rights in the ICO issuer, cryptocurrency, registered securities. I don't know which class you're going to be talking about IPOs, but if you understand what stocks are, there's basically two types of stocks: voting stocks and non-voting stocks, right? Voting stocks is the default, right? And if it's a stock that you can vote, then it's a obvious security, right? When you have initial coin offerings, you want to circumvent all that securities regulation. So it's not going to be voting rights during an ICO. Okay, so it's not it. And obviously not a registered security. Okay. Based on what happened in 2017, 2018, what has been offered during initial coin offering is cryptocurrencies, or what's called utility tokens, just tokens you could do something like goods and services sometime in the future. I don't know what that is. Okay. Lots and lots of scams that occurred in the last. Yeah, I don't know. I can't even think of a good example of a successful ICO in which the token was useful. Okay, so the answer is B. It's cryptocurrency. Okay. All right, last question. What is a blockchain distributed ledger technology that can eliminate intermediaries in transactions? A, cryptocurrency, B, tokenization, C, smart contracts. So based on your understanding of Bitcoin, you should now believe that with the Nakamoto consensus, with proof of work, there is no need to have banks monitor or regulate transactions, right? And the only way that's possible is because they have cryptography involved, right? There's some way to secure the transaction with competition to mine blocks. And so whenever you see a question about eliminating intermediaries on blockchains, we need to talk about cryptography. So B and C, not good answers. Tokenization does not necessarily involve cryptography. You could have a private blockchain, which doesn't need cryptography. So B is not a good answer. Smart contracts, again, not necessary to have cryptography. So C is also not a good answer. So the best answer here is A, cryptocurrency. So the crypto part is what secures the blockchain without an intermediary. You don't need banks. All you need is the consensus, the proof of work consensus. And you can make transactions without banking system. All right. Comments, questions on Bitcoin? So I hope you get a high level understanding of blockchain, at least from the perspective of test makers. Whether they have real value, I've shown you my opinion. I do own some cryptocurrencies just because I'm curious about how to use it, but I don't own exorbitant amount of it. I'm not a millionaire by any sense, but that's my understanding of it. And if you want to pursue that, that's by all means. I don't discourage you to explore it. Okay, it's possible it may find a use case, but I haven't seen one yet. Okay, so let's take a 10-minute break, and then I'll talk about the final exam format and the sample final exam questions, and then we'll call it a semester. Okay. All right, talk to you in 10 minutes. All right, so if you're curious how many confirmations that transaction now it has 5 confirmations. So now you know it's secure, right? But it took us how many minutes to get 5 confirmations, right? So anyways. All right, folks, let's talk about the final and try to leave early. So as you saw from the sample final cover, it's going to be very similar in format. But I had to make the exam a little bit longer because you guys did too well on the midterm. And so I need some way to distinguish those that really understands and those that just kind of understands. So there's gonna be 9 to 10 questions. Again, each question has multiple parts, so I encourage you to be strategic, meaning that you should look through the entire exam and work on things that you definitely know the answer, and then work on the next question, you know, kind of the answer and so forth. So partial credit definitely will be rewarded. So don't be afraid to, you know, write something down, but please don't like write an essay. Okay, so I'm basically looking for bullet points. Okay. On the test day, which is the 14th of December, so make sure that that's true. I think that's right. It's gonna be from 6:30 from 9:30. I'm gonna have my TAs conduct the exams, so they will hand out the exams and do all that exam procedures. Okay. So just make sure that you arrive on time. I believe they will start arranging stuff 45 minutes before the exam. So by all means, you can come as early as that, but we won't let you in the classroom until it's around 6:30. Yeah, open book, open notes, just like the midterm. So because it's open book, open notes, expect more quantitative questions and conceptual questions that you have to think hard on, as opposed to just regurgitating facts, right? Yeah. So a little bit different than the midterm is that you will be required to write your answers on a examination book, which is a blue book. So that means that you're not writing on the test exam paper, you're writing in a book. And when you submit the exam back to us, you put the exam in the book and you hand it to the TA to collect. Okay. So that's the only different, that's format that's slightly different. Okay, so just don't be surprised. Extra paper will be provided, but again, I encourage you to be concise in your answers so that you don't waste time and too much space. There's no need. I don't know how you guys struggled with time last time. There's no need to stay for the full 3 hours. I don't know what you guys do in your undergrad. I don't know if that's like a strategy, but I usually get a wide range of people finishing fast. And those are like the superstars. And then the people that finish, you know, maybe 2 hours, 3 hours, they still get B+, A-. And then the people who didn't study at all, they're just flipping through their notes until for the full 3 hours. So, but my experience from midterm, literally everybody here submitted 3 hours, and I was a bit worried that you guys didn't get anything. But anyways, there's no need for you to stay for full 3 hours. Okay. I believe for the exam format is if in the last 15 minutes you're not done yet, you have to stay for till the end. Okay. So if you're not done by the last 15 minutes, you have, even if you finish 14 minutes, 10 minutes before the time's up, you still have to stay in the classroom. Okay. But if you finish before, you can definitely leave. All right. So that's the test taking logistics at CityU. Just double check that this is in fact your exam date and this is in fact the classroom you're taking it in. I believe that's true. Again, 2 TAs will be both there, that they will have seen the exam and know how to answer questions. Again, something doesn't make sense, you can definitely ask them. And they'll be grading. So they're the best person to give you suggestions. Okay. All topics are fair game. So I get a lot of students reluctant to revisit back old concepts. I may throw in another freebie for you. Okay, so if you just for those of you who studied, reviewed a little bit, I'll give you, that's basically 3 points, right? If you studied past topics. But definitely there's a heavy emphasis on stuff that happened after the midterm. So AADD schedule, XX curve, all that risk management stuff, right? That's all fair game. All right, comments, questions on the final exam logistics. So again, just don't be surprised when you find a blue book, answer book on your desk, right? With your, you have to check your IDs too, remember, get the ID stuff. And be concise with your answers. Do not be verbose, because I'm going to ask the TAs to be slightly harsher, okay? So don't waste space. All right, so let's go over the practice final. The final exam, the sample final questions I gave you, it's obviously much easier than the actual final exam, but just to give you a taste again, what to expect. The first 4 questions, as I said earlier, I won't give you something like this. I probably will combine all 4 questions into one question, like a true false thing. Again, just to give you an idea of what I could ask. I could ask you something about real exchange rates, overshooting, true, false. I make a statement. You have to tell me if it's true or false and explain. You know, in your explanation, you can draw graphs, you can write equations, whatever. Okay, but the whole point is I won't separate the questions into like this. I usually write questions like this if it's a closed book exam, but because it's open, I have to be a little bit. I have to condense things a little bit. Okay, so let's go ahead and go through the questions. So as I wrote in this slide here, the first 4 questions are all qualitative, which means that you can pull the information from the slides. So I won't spend too much time talking about it. So let's go over Q1. So open economy trilemma. So this is the impossible trinity, right? You can't have all 3 characteristics of an open economy. You can't have an exchange rate stability. You can't have monetary policy autonomy, and you can't have free capital flows, right? Capital mobility. You can't have all 3. If you choose 2, you have to give up 1. Remember, that's from the slides. So based on this question, you just describe to me those 3 things. What does it mean to have stable FX markets? That's if you have pegged exchange rate, right? That's an example of stable exchange rates. Yes, so if you choose that, we learn from this class, you can't have monetary policy, right? You have to give up independence of monetary policy. Another feature that we talked about is independent monetary policy, which means you can change money supply at will. And yeah, you talk about that. And if you take on that, you have to give up something else. And lastly, capital mobility. If you have capital mobility, what that means is that you allow speculators to come in to restore UIP, right? That's essentially what capital mobility means. Anybody can come in and correct prices. If you don't allow this, then you could potentially have independent monetary policy as well as stable FX markets, right? As what mainland China does. They have some sort of managed exchange rates, but they also have strong capital controls in which arbitrageurs aren't allowed to restore UIP. Okay. All right. So so in this question, you could also I might give you an example, like true, false. So an example would be like what kind of open trilemma What objectives does Hong Kong choose for their macroeconomic objectives? They have stable stable exchange rates because their currency is pegged, and they also have capital mobility. So if they choose those two, they have to give up monetary policy. The U.S. chooses independent monetary policy and floating exchange rates, right? So they have to accept, floating exchange rates. So they have to accept monetary, they have to accept fluctuations in their exchange rates because they allow capital, free flow of capital, right? And I already gave you the China example, right? All right, so that's Q1. Comments, questions? I think this is directly from the slides, so I won't spend too much time on it. All right, current account imbalances. Policymakers are concerned with current account imbalances. So imbalance just means the current account is not zero, right? So in this class, we talked about the current account in two ways, right? One in terms of import exports, but also in terms of lending and borrowing, right, between countries. And we talked about the pros and cons of having a large positive current account and also negative current account. So you might want a large positive current account if you want to stimulate exports, which can promote your domestic companies. But there's a downside to this because, as you know, if you're too focused on exports, you're going to be a net lender, and net lending means that you may be you're over investing, you're foregoing investments domestically, right? If you're going to be investing abroad, in which case you may be undermining the development of your non-exporting companies, right? Another downside of excessive exports is the fact that you may be investing in countries that don't have good credit. They don't deserve the credit. So if China invests in Africa, but as you know, Africa probably won't grow as fast as the investments, as the returns, expected returns, and you might lose a lot of money as a result. So bad investments. So the risk return trade-off is not appropriate in that situation. All right, so that's the downside of excessive positive current account. The downside of excessive negative current account, I think it's obvious, right? If you're borrowing and consuming imports too much, then you're not too focused on producing things, right? If you're not, because in order to pay back your trading partners, you have to export some goods sometimes in the future. And if you don't meet that growth target, then your credit worthiness is going to decline, right? Nobody's going to lend to you anymore. So it's not good to be a net lender that's too negative or for too long. Okay, so that's my discussion of the pros and cons of excessive positive or negative current accounts. And you can give examples like I gave already. China stimulating growth through exports. And what about your non-exporting companies? Right, these are all things to think about. All right, real exchange rate. State the law of one price and purchasing power parity. Explain the law of one price. Why the law of one price implies PPP condition you stated must hold. All right, so we know that the real exchange rate, the Q function, right? Q equals EP star over P, but we know that that representation has some sort of implications about the exchange rate, being able to convert prices between countries. So the strongest form of the real exchange rate is called the law of one price, which means we can use the exchange rate to convert any asset, commodity, goods or services between two countries, right, accurately, right? But obviously this is not true for many reasons, like differences in competition, industry competition between countries, tariffs, taxes, etc. Input costs, all these things could distort prices between, making the foreign exchange rate unable to translate goods and services between prices between two different countries. All right, so what about a weaker form of the law of one price? We learned that the next weakest form of the law of one price is called the absolute purchasing power parity. Absolute PPP states that the average price of goods and services should be equal across countries after currency conversion, right? Average prices. But that makes a big assumption that the consumption baskets between goods and services across countries are more or less the same, right? So that's a reason why it could break. Very different consumption baskets, and therefore absolute PPP doesn't work. In other words, Q doesn't equal to 1, right? It's not equal to 1. Okay. Lastly, the weakest form is called absolute PPP, which states that it's okay for Q to be different from 1 as long as Q is constant over time, right? It's just saying that the change in the real exchange rate is 0, right? Yeah. And for the most part, if you look at the data, relative PPP does look like to hold, at least within developed countries. But of course, it could break from productivity shocks. We talked about it, right? From developed countries transitioning to developing countries transitioning to developed countries, in which you have productivity shocks, which can distort Q for a very long time, right? Non-constant. All right, so I talked about each of these versions of the law of one price. I gave you reasons why they could break, which you should all think about. And you should also convince yourself how to prove that the stronger version of the law of one price, real exchange rate, implies the weaker version, right? It's very easy to prove that. I hope you can see it, right? If E can translate prices between countries for every goods and services, then the average must be true as well. And if the average is true, then Q equals 1, which is a constant, therefore absolute PPP holds, right? So stronger version implies the weaker versions, but the weaker versions do not imply the stronger version. All right, so that's my discussion on real exchange rates. Again, kind of questions I'm asking you is true, false on examples that I gave you, why relative PPP could be violated, etc. All right, 4 is a observation from pre-midterm, right? The observation is based on UIP and the money market equilibrium equations, we can simulate volatility in the FX markets with some assumptions, right? Namely, monetary policy shocks and sticky prices. When you have those two things, you get volatility, right? Meaning that you get excess, you get a exaggerated change in the exchange rate followed by the reversion. Right? That's what overshooting means. So number 4 states, can there be exchange rate overshooting if prices are fully flexible? Discuss briefly, considering nominal money supply and real demand shocks. So as I said, you get this overshooting only if you have that 2 ingredients, right? You have sticky prices and a monetary policy shock. If you have flexible prices, then temporary monetary policy doesn't do anything, right? Because the real money supply curve doesn't change. If the monetary policy is permanent, then you get something in the long run, right? Short run and long run, right? Because expectations change. But under flexible prices, only effect is in the long run, right? You don't get that amplification in the short run because you have flexible prices. All right, to summarize again, fully flexible prices means you don't have that sticky price, which means temporary monetary policy doesn't work. If you have permanent monetary policy with fully flexible prices, you only get an effect. You only get that expectation effect, right? You don't get that sticky price effect in both the short and long run. All right, anyways, that's my discussion. I think it's obvious based on the fact that you've done this, seen it over and over again. And yeah, so again, expect some kind of true false question maybe I could ask on overshooting, right? Given those criterias. So don't expect too much of those pre-midterm drawings, right? I think you're more or less done with that. But you can if you want to use it to make your case for true false questions. Okay, comments, questions on Q1 through Q4. If nothing, then I will go through these other questions. All right, so these other questions, these other exchange rate determination questions is just shifting the AA, DD, and XX curves. Right? Just be comfortable doing this. There's literally slides in the handouts, right? The slides that tells you which curves shifts when certain variables change. I even have a slide how to shift the XX curve too, right? So you should be masters at doing that. And so the kind of questions I could be asking you is just shifting those curves and then analyzing the long and short run effects, right? Depending on if you believe that prices are flexible or sticky. And then you have the subcategory of analysis in which you have fixed exchange rates, which is not that interesting, right? Because there's no such thing. We don't really care about flexible prices because the fixed exchange rate has to be fixed no matter what. All right, so that's the summary of what you should know how to do, okay? And this is just an example of shifting those AA and DD schedules. All right, so let me read Q5 question. An economy with a floating exchange rate suffers a negative demand shock for its export goods. What effect does this have on the current account and aggregate demand in short-term equilibrium? Use a diagram that shows the nominal exchange rate, output, and some current account target. So what that means is that you should start out with an initial equilibrium, assume that the country already has hit the target, okay? And then shift the curves and see where the new equilibrium is relative to the target. Okay, so I think that's what the question is going with. Use the diagram to analyze how a temporary monetary policy intervention can restore the output level. Does the policy have to be contractionary, expansionary? Does the current account attain its target level? So everything else is just visual. So once you have the graph, it should be quite easy. All right, so let's think about what changes. So I said there's an export demand shock. So it's possible that certain countries no longer want to buy goods and services from you. So an example would be like export of, let's say there's a recall on a food item that's poisonous, right? Like baby formula, and therefore export shock to this country, right? Nobody wants to buy baby formula from you anymore. Yeah, so that's going to impact the EX in the current account equation, right? CA equals EX minus IM. So exports drop. And that's what I wrote here, right? And as a result, Y has to drop, right? Because we learned from our Keynesian cross or aggregate demand equation, right? When you have CA dropping, then it's going to be that, right? And therefore, Y has to decrease, right? So to review the idea, Keynesian cross says demand creates supply. So if there's less demand, the supply will go down. So that's the intuitive mechanism at play. All right. So with the exchange rate fixed, right? We haven't changed E, but there is a drop in the CA function for some reason. Then output's going to decrease. So that's going to be reflected as a leftward shift of the DD schedule, right? So E hasn't changed, right? We haven't changed E. So if you look at the graph, we see that the DD schedule shifts this way. So all else equal, if we haven't changed the A schedule, we should be here, right? DD moves from here to here, and we end up here. So why do we end up here instead of here? We can walk through the analysis here, okay? So a decrease in Y will lead to a decrease in interest rates, right? Because of this equation. MS equals E times L R Y. So if we have a decrease in Y, then L is going to decrease and as a result, this is going to be distorted. We want to restore it. To restore it, we need to change E in such a manner that increases L, and that's only possible if R decreases, right? We need to have R decreasing, and R decreases only if E increases, correct? Because R is equal to R star plus E hat E over E minus 1. All right. So decrease in Y leads to a decrease in R. And one way to think about this is now everyone has less income. They're not going to be spending. They're going to be saving. They're going to be moving their liquid cash into less liquid cash that pays better interest rates. So investors are now buying bonds, and when they buy bonds, bond prices increase, bond yields decrease, interest rates decrease. With interest rates decreasing, the UIP curve that I wrote here is going to be violated in this direction, right? And therefore, E has to move in a direction that restores parity, and that's only if we increase E, right? So that's the economic explanation of what I just explained using mathematics. Yeah. Cool. So what does that look like? It means that we're moving from here to this point here. And let me erase this. So first we had a shift in the DD curve. So we started from here, we moved here, and then we moved up this, from here to here, but we're not going to here. We're going along the AA schedule, right? All the way to here, right? That's what I just described. We're moving along the curve. As Y decreases, E has to increase, right? That's why we're moving along the curve. And at the end, we get a delta Y that's negative, right? Okay, so that's the first part of the question. I believe it also asked you, relatively speaking to the XX schedule, where are we? We're going to be above the target, interestingly, right? For the given Y and E combination, we're above the target. All right, the second part of the question asks you to implement a policy that allows us to restore the output, and they suggest using temporary monetary intervention. As you will see, it should be expansion, right? It should be obvious because we need to move AA in a direction that restores the change in output, right? So A should increase, should go upwards, should move upwards. So let's go ahead and walk through the logic, right? So if we increase money supply, that's going to, same logic here, right? That's going to skew the inequality this way. That requires interest rates to go down. And UIP tells us that's going to require E to go up. So it's the same logic as above here. And with E increasing, that's going to increase Q, it's going to increase CA. So this is the feedback. This is a feedback into DD schedule, right? And therefore Y is going to increase as a result. So that's as if we're moving from here to here, right? E is increasing, output's increasing, and we're settled at this point here, right? Because we increase A to counteract the change in output. And the last comment asks you, where are we relative to the old target? We're going to be above the target. Okay, we're above the target. So remember, the target is a representation of a combination of E and Y, right? What is the appropriate exchange rate, target rate between output and E? Here it's saying for that output, our E is higher than we want it to be. Okay, that's all it's saying. So X is a representation of the exchange rate. Yeah, you can think it's a slope. Okay, the slope between the change in Y, a change in Y and a change in E. Okay, and this is saying that for that change in Y, we're changing too much E, and so it's going to be above the target rate. So not ideal, in other words. Okay. All right, comments, questions. So summarize again what we've done. We started out with an initial equilibrium, right? AA schedule intersects with a DD schedule. We draw an XX curve through it, assuming that the country has achieved its current account target. We now implemented a demand shock, which impacts EX, which impacts the current account, which impacts output. Keynesian cross tells us that demand creates supply. So if there's less demand, there's less supply. Less supply means that the DD schedule is going to move to the left for a given E. And we conclude that that's going to be above the target. We try to counteract this recession, essentially the output shock, with monetary expansion, but that's going to require us to compromise our currency further, weaken the currency further. And of course, we can undo the output shock, but it's going to cost us, right? It's going to cost us a significantly more change in E than we want. So we're not going to hit our current account target. So there's no long run, short run analysis for this question, but you can imagine extensions here, right? I could say it's a permanent shock. You have to think about price effects, short run, long run, blah, blah, blah. I'll leave that to you to think about. All right. Question 6, monetary shock. All right, so there's some short run, long run analysis. So this question wants us to show the effect of a negative monetary shock on the current account, interest rates output under a floating exchange rate, using a diagram that shows nominal exchange rate and output distinguished between short and long-term equilibrium. Does it matter whether negative monetary policy shock is temporary or permanent? All right, so what we're doing is we're comparing a temporary versus a permanent shock. And we're analyzing short and long-term equilibrium under the AA and DD schedule. So temporary monetary shock just means that expectations don't change. And the only curve that changes is in the short run, which is the AA schedule, right? It's going to go downward, right? Because it's a decrease in money supply. So let's walk through the logic here. Again, it's easier if you write down the equation. So if we have a decrease in MS, that's going to give us this inequality. And in order to restore parity, all else equal, you have to offset the L somehow under sticky prices. And that's only possible if we increase R somehow. And that's only possible if we have a decrease in E. So exactly a decrease in E. The economics is the following. If there's less money in circulation, that naturally means that people are selling bonds back to the central bank, in which case prices are decreasing and rates are increasing. Yes, and the A schedule therefore shift down. So we get, okay, so I didn't draw the temporary case, but imagine there's a temporary case, then AA shifts downward, yes. So like, let's just say it's here to here, okay? All right, that's just let's see. That's just okay, so let's walk through the logic from going from here to here, right? The logic is the following. If you have a decrease in E in the DD schedule, that's going to be a decrease in Q, which means current account is lower, which means output is lower. And the Q is a representation of import-export competitiveness, right? And if your currency is too strong, then it's harder to compete in the global international trade. And as a result, output is going to decrease. And we're moving along the DD schedule because a decrease in E means a decrease in Y, which means that we're moving this way, right? Decrease in Y is this way, decrease in E is this way. So that's how we arrive at this point here. All right, so that's temporary case. Let me erase it because we need to talk about the permanent case. Permanent case. Permanent case, you have an additional effect. You have now expectations going the same direction as the change in money supply. And that's going to be an amplification effect on E. And you can see it because R is going to require an even steeper decrease in E to restore equality, right? So you need R to move, E has to move in a stronger manner to restore parity. And so that's why you get this super exaggerated effect in the short run here. Okay. And the logic from moving from this point to this point is the same logic as I mentioned earlier, right? You have interest rates increasing, central banks selling bonds, R is increasing, so carry traders come in to borrow foreign and lend out, invest in domestic. That's going to push up the price of domestic currency, et cetera, et cetera, et cetera. Okay, so that's under sticky prices. So that's the short run. Now, long run analysis, we have that additional thing to think about. We have price flexibility. So the AA schedule is going to move back because under flexible prices, your monetary policy, real money supply curve didn't change, right? Interest rates didn't change. What has changed is expectations, right? And therefore, AA schedule still remains slightly below the previous initial curve, right? So you go from here, that's number one, to here, and then you go back to here. All right. So, but something else has to happen too, right? If we have prices increasing, that's also going to impact the DD schedule, right? Particularly since the change in P is going to be the same as the change in E, right? If that's true, then it's as if the Q, right? It's as if Q, no change, right? So recall Q equals EP star over P, and if E and P changes the same in the long run, then Q didn't change, and therefore no change in output. And that's why we're back here, right? We're going to move the DD schedule this way until we get no output effect. So walking through the logic, right, you get a decrease in P, increase in Q, increase in current account, increase in Y. So the Y is completely undone, right? This Y is undoing the initial change in Y here, right? All right, so that's all you have to talk about. If I ask you something like this, you can show this graph. Talk about long run, sticky long run condition, meaning flexible prices, sticky prices gives you the short run, and so forth. Yes. So to answer the last part, does it matter whether the negative monetary shock is temporary or permanent? Of course, right? If it's permanent, you get this amplification in the short run. on the strengthening of your currency. And that effect is sustained even in the long run because expectations have changed, right? So remember from this graph, our initial E was here, and afterward it's here. E prime. Right. Anyways, this is like this is the reverse of what we talked about in the slides, right? So hopefully that's not just review. We're just using our brains to practice walking through the math, thinking about which curve shifts, trying to understand the economic mechanisms at play, and thinking about the difference between short run and long run to make forecasts of where the equilibrium point changes, right, between those two scenarios. All right, comments, questions about monetary shocks. So obviously this is about floating exchange rates. We did talk about fixed exchange rates. So my advice, again, study scenarios in which you have fixed exchange rates. Think about monetary policy shocks, think about fiscal policy shocks, think about liquidity traps. These are all discussed during lecture, right? So just review it. And you don't have to spend time digging through your notes and just finish earlier. Your exam. Okay. Question 7. This is a qualitative question, so don't expect a question to be so simple. I probably combine this question with true false questions, but in any case, let me read you question 7. Suppose an economy with a large and unstable government sector has a sound monetary policy. So sound monetary policy just means it's very credible. If it does anything, people will believe you. It changes expectations, and that's basically what it means, okay? The economy suffers frequent fiscal but hardly any monetary shocks. The country wants to choose an exchange rate regime that stabilizes output and employment. What exchange rate regime would you recommend? So based on my reading of this, I believe the best answer should be a flexible exchange rate regime, because that allows you to use monetary policy to its full extent, right? It has a sound monetary policy, which means it's very credible. It can buy bonds, it can sell bonds and influence interest rates, no problem, right? So if you have that ability, then you should take advantage of it. And adopting a flexible exchange regime gives you that power, right? So fiscal policy unstable, no problem. You just counteract it with your monetary policy. So fiscal policy is like perhaps an example of fiscal policy uncertainty is like the government can't agree on what to spend money on. And if they can't spend money on something, they may cut things, right? So this is something that happens all the time in the US, and they always run into emergency congressional meetings where they have to approve budgets, otherwise certain policies expire. But if it does expire, at the very least, in this example, the central bank can come in and stimulate the economy through monetary expansion or contraction. So yes, so that's my answer. So if you have sound monetary policy and you want to counteract unexpected fiscal shocks, you should take advantage. You want to adopt a currency regime that allows you to maximize the potential of your monetary toolkit, right? Changing money supply, influencing interest rates, and so forth. All right, so that's what I wrote, right? So something to think about would be, suppose you have predictable fiscal policy, very conservative country, but non-credible monetary policy, right? Which one? You would probably adopt the opposite, right? You want to make your fiscal policy stronger, as we learned from a few weeks ago, right? Hong Kong should have very strong fiscal policy, because if they do stimulus, they have to change their money supply to keep their exchange rate stable. Otherwise, it's unsustainable. So they can get the full power of fiscal policy in that scenario. All right. Yeah. So think about how I can ask this in the true false sense, but it should be easy to explain, right? All right. So that's the kind of questions I could ask for the macro slash FX rate determination. The rest of the questions are just very standardized derivative questions applied to foreign currencies. Okay. So do you have any questions on FX determination, macroeconomics? Otherwise, I'll move on to risk management. All right. So definitely expect 1 or 2 risk management questions. Okay, maybe more. Because that's a big component of international financial management, right? The management part. The management part is managing your risk, right? FX exposure. So question 8 is about hedging using forward contracts. Yes, so full hedging. So let me read you the question. Suppose Hong Kong importer plans to import 10 million euros worth of European luxury handbags 1 year from today. Outline a hedging strategy so that the importer eliminates currency exchange rate risk completely. So we learned from a few weeks ago, forward contracts, if we hold that contract all the way to maturity, expiration, we can eliminate risk completely, right? And in this case, you have a liability, right? Because you're planning to buy something. So you need to, you get something, but you have to pay out something. What do you have to pay out? You have to pay out 10 million euros. But you can buy the euros today, or you can buy a forward contract or engage in a forward contract, right? If you buy it today, you run into the fact that euros may be cheaper in the future, right? Do you want to take the risk? I mean, you don't have to spend that money if you don't have the money today. But anyways, by design, you have a 10 million euro liability that's due in 1 year, and you want to eliminate the cost of buying euros in the future. So you engage in a forward contract. So all we have to do is outline the steps to hedge against fluctuations of the price of euro. So using the mathematical formulation we learned in class, I'm going to use G function to designate our payoff function that's unhedged, and then the F function to designate the payoff function of the forward contract we're using, and then add these 2 functions together to get the total payoff function and demonstrate that the total payoff function is going to be not exposed to a random variable. Okay. So unhedged payoff, as I said, liability, which means we have an outflow of currency sometime in the future. So that means we have to buy euros at a price of E1, and we're going to buy 10 millions of that, and it's going to cost us in terms of Hong Kong dollars. Agree? So multiplying E times any amount of number is going to give us the domestic currency, in this case, Hong Kong dollars. So if we don't hedge, we have to go out and buy euros in 1 year or sometime before that, and that's going to cost us negative E, which is uncertain, right? It has a distribution of possible realization, and we're exposed to that uncertainty. To eliminate that uncertainty, we can engage in a long forward, which means that we're going to pay a fixed known price today and get deliverance of that foreign currency in the future. So it's minus F, as I said, a fixed price known today, minus F, and we get E1 today. Okay, that's the price per unit of euros multiplied by 10 million euros. That gives us Hong Kong dollars. So adding these 2 together, G of E plus F of E, will give us minus E plus E minus F. These go away, and we're only exposed to minus F, which is not random. It's a known variable today, and it won't change in value from today all the way to 1 year. So we are no longer exposed to fluctuations of euro value. So that's how you hedge with forward contracts. Of course, this is a very, very simple payoff structure. It's possible I ask you to combine forward contracts with options or something like that. I don't know. Things become more complicated. Then you have to tell me what kind of portfolio you have to construct. And the subsequent questions on the sample exam, we'll talk about portfolio of derivatives. Okay. But anyways, this is a taste of what I could ask you with regards to forward contracts. Comments, questions? I think it's straightforward. All right. Before we go on to, I believe, okay, before I go into the option stuff, we have a question of swaps. Swap valuation is actually quite complicated when you have counterparty risk. We didn't ever talk about default risk here. So we're only talking about, we're assuming that our counterparty is always very, very creditworthy and is riskless, and we will always get the full timeline of interest payments if we ever engage in a swap. So anyways, that's what we learned in this class, right? So think of swaps as an exchange of bond interest payments, and you don't have to think about counterparty risk. The only thing you have to think about in terms of risk is whether or not interest rates or FX rates are changing from now until maybe 1 year from now or 2 years from now, in which case the value of each of the swap leg could change, right? So remember, swaps are a portfolio of bonds, one inflow of payments, and the other is outflow of payments. So yeah. And so outflow is called a leg, and the inflow is called another leg. Okay. All right, so let's look at this question. Suppose you want to enter into a 4-year currency swap agreement so that you receive US dollars. So this is receive. So that means you're going long on dollars, and your counterparty receives euros, and that means you're going to short euros. So you're giving away euros, you want to receive dollars. Assume the notional amount is 10 million US dollars. Notional amount refers to the amount of money in which you're charging interest on, okay, that you get cash emissions or interest payments. Notional just means an arbitrary number, okay? But you can think of it as the par or principal value of a bond. Okay, we're assuming that in this class, we're assuming that for swap contracts, we're also reserving the notional amount at the end of the contract, okay? At the time of contract origination, the spot Euro USD exchange rate is 1.23. So that means the price of euros in terms of US dollars is 1.23. US interest rates is 1%. Euro interest rate is 2%. Suppose after year 2, euro appreciates and the spot exchange rate increased to 1.25. What is the value of the currency swap contract, ignoring currency and credit risks? Okay. So interest rates haven't changed. The only thing that has changed in this question is the FX rate. Okay, and we're going to assume the FX rate stays the same from now until into the future, in which we could price each of the swap legs separately, right? All right, so let's look at what's being paid out for each leg. So for the euro, it's 10 million US dollar notional value converted to euros. So this is the notional value for euros. 1% on 10 million is 0.1 million. 2% at 8.13 million euros is 0.163. So those are the interest payments each period. The value of the USD bond and euro bond is just the DCF. You're discounting the cash flows plus the final par value plus interest discounted by the interest rates. We're assuming that the yield curve is flat. So it's 1% for US, doesn't matter which time horizon, and 2% all the way, doesn't matter which horizon. So the value of USD bond is just the discounted cash flow, 0.1, and then the notional amount plus 0.1, you still get 10 million. So this should not be surprising because nothing has changed for the US side, but the price of euro is going to change because exchange rate is going to change. So this also should not be surprising, right? Assuming FX rates stay the same, the price of euros is also 8.13, right? but the difference is going to be non-zero because FX rate changed. All right, so 8.13 times 1.25 gives us dollars, and it's going to be greater than 10 million. And so the price of the euro leg is going to be positive. And what that means is that if the counterparty wants to undo the swap, they have to buy out the euro leg. They have to pay the euro leg to stop. So extensions of this problem that could be asked on the final exam. I can change 1% to something else. I can change 2% to something else. I can change the 4-year swap to 10-year swap. You know, this only limited amount of variations I can ask you on this question, right? But just be comfortable with that idea. Okay. So reading this question, you can obviously see the assumptions I made, right? I assume that the FX rate can be applied every year, even though it changed in year 2. I assume that the exchange rate persists in year 3 and year 4, and that's why I'm just using the spot rate today, right? I also assume that the term structure is flat, and you shouldn't be concerned that I'm not going to use any sort of complicated term structure. It's going to be flat as well in the exam. Right? But at least you get the idea, right? Interest rate changes, spot rate changes, the price of one leg or the other leg is going to change, and therefore that means one leg is going to be more valuable than the other side has to buy out the other leg in order to undo the swap. Comments, questions on currency swap valuation. So should be very, very obvious if you know how to price bonds, right? The only thing that's tricky maybe is the FX rate. Okay. All right. So the portfolio of option stuff. You should expect one question, okay, on the exam, where you have to construct a portfolio of options, tell me what the payoff structure looks like, do a payoff table, and draw the graph, etc. Okay, so that's what we're gonna do. We're gonna do 3 examples here, I think. 10, 11, yeah. We're gonna do 3 examples. And I don't think I need to spend too much time. You just need to practice maybe once or twice, and you should get the hang of it. So I'm just gonna give you 3 types of portfolios, popular portfolios. So if you look at the surveys of risk managers who engage in options, they only use so many types of portfolios. They don't do anything, pretty much, they don't do too many things that are exotic. One is called a butterfly spread. One is called a long straddle, and the other is called a bear call spread. Okay, so these are just examples of risk managers that they use. I'm gonna go over them and tell you what the payoff function looks like, etc., and then give you some pictures to show you what the payoff structure looks like. All right, butterfly spread. Butterfly spread involves the following. You have to long one call option at a strike price of something lower than the spot price. Okay, so -1 is arbitrary. You have to short 2 call options with a strike price equal to the current price of the currency. And then you have to long a call option with a price of a strike price of some value greater than the spot price. So ET is the spot price. So long one call that's strike price that's lower than the spot price. So that's in the money, right? Short 2 call options at the money, and then long 1 call option that's out of the money, right? So I hope you understand that terminology. So in the money means that if I were to execute today, if I were to redeem the option contract today, I would make a positive payoff. At the money means that I break even. K equals the strike price. The strike price equals the spot price. And out of the money means that the strike price is, for call options, is greater than the spot price, which means that if I were to execute, I get negative payoffs, so I would never execute today. Okay. All right, so in this example, I told you that the spot price is 1.1. And to analyze this portfolio, you need a payoff table. and it'll be very clear what the shape looks like. So let's go ahead and analyze using a payoff table. So the hard part for using the payoff table is you have to imagine the different scenarios in which the future spot price could be relative to the strike prices, right? That's the difficult part. So here I iterate through all the different scenarios that could happen. ET could fall below ET minus 1. ET could be between the two strike prices. ET could be between another two sets of strike prices. And ET could be greater than 2.1, like the largest strike price. So I go through these scenarios, and I write out the payoff for each of these positions, right? So long one call, that's in the money. So in the case in which ET is lower than ET minus 1, 0, because I wouldn't execute, I wouldn't redeem. Otherwise, I would have a positive payoff in all scenarios, right? Because the underlying asset increased in value, right? Or stay the same or increase in value. All right. Second scenario, second position, short 2 call option. Short means that the counterparty is going to redeem, could redeem or exercise the option in the case in which the underlying asset price exceeds the strike price. And that only occurs in these 2 columns, right? So it's a minus because I'm shorting, okay? In which case you can see it's a plus for me today, right? So the first column is the payoff today. If I long 1 call, I have to pay for it. If I short 2 call, I receive money today, but I have to pay out in the future. All right, lastly, you have a long call out of the money, and it's only in the money if ET exceeds 2.11. Okay. Now we add up everything, right? So we add up all the columns. So our final payoff structure looks like the following. These 2 looks like a positive slope, right? Positive slope with an intercept turn at negative 0.11. And then we have a negative sloping line with an intercept term of 2.11. So this is a review of algebra, so I hope you should be comfortable with point slope form. So just be careful. All right, even if you don't know point slope form, at least you can hopefully plug in some numbers and then see what it looks like on a graph. All right, so we can go ahead and do that. So as I said, positive slope, negative slope, and if you consider the fact that this is positive, right? All right, negative, payoff is negative, then the entire curve must shift downward. It has to be negative, right? Because if it's not negative, then it's a free lottery ticket, right? I could get 0, but I could get all upside. Otherwise, yeah, it has to be a negative number. Okay. Okay, so intuition for butterfly spread, the intuition is you're betting that the underlying asset doesn't change, right? It doesn't change. It stays around its current price, which is what, 1.11, right? I believe this is 1.11. So if it doesn't move, you make some money. Great, right? That's the bet. So you would implement this butterfly spread if you think the underlying asset won't move that much. Okay. So with premium just means with price, and without W/O is without premium. So that just means price. Okay, so price premium I'm using interchangeably here. All right, so just on your own, walk through, redo it, get comfortable, iterating through different possible scenarios, write out the payoff, sum across columns, plot it. That's something you will do on the exam. Okay. All right. Long straddle. A long straddle option strategy profits based on how much the price of the underlying foreign currency moves. Okay, so this is going to be betting that the underlying price have wild swings. Okay, so this is another popular strategy that some people use if they think there's a lot of excess volatility of a particular underlying asset or currency. So we're in the context here is suppose we are going long volatility on the Israeli new shekel. So as you know, Israel is going to war, and I think if you were a speculator, you would speculate volatility on their currency. Okay, so how do you do that? Let's go ahead and do the following. Let's long one call option and long one put option at the money. So at the money means the strike price is equal to the spot price. And let's assume the current spot price is 2.08. And let's go ahead and analyze using a payoff table. So long one call, long one put, minus C minus P. So total price is going to be negative, obviously. Two scenarios to think about: whether this underlying spot price exceeds 2.08 or falls below 2.08, right? That's the only two scenarios to think about because there's only one strike price here, right? So long call, again, you're betting that the underlying asset price, underlying foreign currency appreciates, and you get a positive payoff if the underlying asset exceeds 2.18, which is ET minus 2.18. Otherwise, you would not exercise. Put option, you're betting the opposite. So your payoff is 2.08. That's the strike price you can sell that, but you have to buy back at negative ET and zero otherwise. So sum across columns, you get a negative sloping number and a positive sloping number, right? So it looks like a V, right? Yeah, it looks like a V. It should look like a V. So in fact, yes, it looks like a V. So I think it's intuitive. You're betting that the price doesn't stay here. You're hoping that it swings here or here, right? In which you make money. So this is a long volatility strategy using options. Okay, if you want to factor in the premium, which we know it's negative, it has to be negative, right? You can shift the curve down. I didn't give you numbers, but I could give you price numbers in which you could determine how much to shift down, right? Comments, questions, long straddle. All right. Last one, bear call spread. Suppose you want to construct a bull call spread to profit from a moderate increase in the price of the euro, which currently trades at the following: spot price $8.52 Hong Kong dollars. A bull call spread involves a long call and a short one call. Strike price equal to the following: one at the spot at the money, and the other out of the money. ET plus one. So the plus one is arbitrary. It could be plus anything. And we're going to payoff table and then plot it. Payoff table, long one call. That means minus, pay something today. And three scenarios: falls below the spot, falls between the spot and ET plus one, and it exceeds ET plus one. Okay, three scenarios. We get a positive payoff if it exceeds the spot, right? In this case. So positive, and zero otherwise, you would not exercise. Short a call option, only exercise. Oh, so short, that means you get money up front. So it's you get a positive payoff today, but you have to pay out your counterparty in the future, and they would only exercise if the underlying asset exceeds 9.52 ET plus one, right? So, and then there's a minus sign because you're shorting. Okay. Summing it up, we have this, right, for your payoff today, but then you get a positive sloping curve and then a flat line at one, right? So it looks like this, right? So you can go ahead and plot it, right? You get a positive sloping curve and then you get a flat curve one. Based on this graph, if there's no premium, it's a free lottery. So there has to be some cost. So there's going to be a downward shift in the curve as a result. So again, this is arbitrary. I didn't tell you the price. I just chose this pointers arbitrarily. Okay. I think that's it, right? So I went through butterfly sled, options, long straddle, bear call spread. Um, so what to expect? Um, as you learn, as you know from the midterm, the questions, the core of the question is very simple, right? It's shifting some curves or drawing some payoff tables, but I like to window dress it to give you some context. So to do the exam successfully, you just have to be able to read carefully, right? And interpret the English and translate that to math or to graphs. So of course, if I give you a question like this, I will give you some context. The context would be something like this, right? You're a Hong Kong importer, right? You're selling something, you have a liability, and you try to hedge against future fluctuations. You have a portfolio of contracts, options contracts, etc., etc., etc. So context is what makes all this stuff interesting, right? Solving math is not so interesting. You just do it over and over again, and you get used to it, and there's not much to test. But being able to digest real information, real context, and translate that to math, that's the core of being a financial economist. Okay. All right. If no other questions, I want to leave you on this page. So let me summarize what you've accomplished in this class. So I hope that you took away from this class a framework to understand how exchange rates are related to interest rates, prices, international trade. I think most people before taking this class have no really good understanding of where FX rates come from. And now you know there's a financial side, there's a banking side, and there's also a real goods and services side. And you know how that's all interconnected now. At least you have a way to think about it. Secondly, you know the role of central banks. So we didn't talk much about central banking, but you know, we only talked about it from the context of FX rate determination. I could spend another semester just talking about the role of central banks and controlling GDP and inflation, etc. But we're not going to do that. Okay, so, I mean, we didn't do that. Our core message here is about FX rate determination, and of course, also managing FX risks. And we talked about all those derivatives that you would have talked about in your derivatives class, but we modified it for foreign exchange rates, right? For forward contracts, we talked about swaps specifically. That's different, right, from your other classes. We also talked about options pricing, but now with foreign currencies, right? We had that extra RF term, right? We have to think about what that meant, right, for foreign currencies. For futures, we also talked about the cash and carry, right? There is an intuition for the future spot parity for commodities, but now you know that it's the same thing as for CIP. Those two equations are identical. So overall, you probably didn't learn much if you had a derivatives class, but now you have some intuition about what it means for FX currencies. Okay, so good luck for your next semester, and I hope you learn. Most importantly, I hope you learned something. Of course, if you haven't filled out the TLQ, I encourage you to fill it out. This is my first time teaching accounting students, so I really don't know how much you learned and how much I had to fill in the gap. So comments are encouraged. Okay. Yeah, so that's all I have. Thanks for taking the class, and it's a pleasure teaching, and good luck on the final.